Hello, thank you for joining us today. My name is Carl and I work in the legal team at Hazlewoods. We specialise in providing accountancy services and advice to law firms. Today we'll be discussing pre-year-end tax planning for individuals. Personal allowance. The personal allowance is reduced by £1 for every £2 of net income over £100,000. As a result, the marginal rate of tax for income of between £100,000 and £125,140 could be as high as 60%. If your income is close to these thresholds, consider ways to reduce your taxable income, such as making pension contributions, charitable donations, deferring your income into the 2022/23 tax year, or transferring income generating assets to your spouse. Charitable donations. Any donations to charity will reduce your tax liability by extending your basic rate band. For example, if you donate £800, this is grossed up to £1,000 on your tax return, and your basic rate is extended by this amount. If you are a higher rate taxpayer, this will reduce your tax payable by at least £200. Consider making additional charity donations before 5th of April 2022. Also, dig out any gift aid certificates so they can be included on your tax return. If you are a partner in a partnership or LLP, ensure that any donations are made in your own name, not through the partnership, to ensure tax relief is available. Pension contributions. The annual allowance for pension contributions is £40,000 for the 2021/22 tax year, although this is reduced proportionally for individuals with taxable income above £240,000 until it reaches a maximum contribution level of £4,000 at a total taxable income level of £312,000 or more. Anyone who is a higher rate or additional rate taxpayer will receive tax relief at their highest marginal rate on any contributions into pension schemes. Consider making additional pension contributions to utilise your allowance for the 2021/22 tax year. It is also possible to use unused pension contribution allowances for the previous 3 tax years. Specific pension advice needs to be taken before making any decisions. Savings. The savings nil rate band means that the first £1,000 of savings income is tax-free for basic rate taxpayers. This drops to £500 for higher rate taxpayers and to nil for additional rate taxpayers. In addition, for individuals that only receive investment income in excess of the personal allowance, the first £5,000 of interest will be subject to the starting savings rate of 0%. If you are a higher rate or additional rate taxpayer and you receive large amounts of interest income, consider transferring savings held in your own name to your spouse. If you have loaned money to your company, consider paying yourself a commercial rate on the loan to fully utilise these allowances. ISAs. The maximum investment limit for an individual savings account, or ISA, is £20,000 per person in the 21/22 tax year for UK residents. Any growth in the ISA is free of both income tax and capital gains tax. If you have surplus cash, consider utilising some or all of your ISA investment limit. Junior ISAs are also available for children under 18, up to a maximum of £9,000 in the current tax year. Again, advice is recommended before making any investment. Business expenses. As a partner, if you incur business expenses personally and are not reimbursed by the practice, you may be able to deduct them from your taxable profits and reduce your tax bill. Common expenses include motor running costs, funding of capital, and working from home costs. Make a list of all the expenses you've incurred personally where you believe there is an element of business usage. Have this to hand to send to your accountant when you submit your tax return information. Dividend allowance. The dividend allowance means that the first £2,000 of dividend income is tax-free. Ensure that you have fully utilised your dividend allowance for the 21/22 tax year. If not, consider paying yourself a dividend. Spouse planning may also need to be considered. Remuneration. Director shareholders should review their remuneration package in advance of the tax year to ensure that it is as tax efficient as possible. Consider paying a combination of low salary, high interest and high dividends. This could result in tax-free income of up to £20,570 in both the 21/22 and 22/23 tax year, and double that for couples, depending on the circumstances of the individual. Capital gains tax. The capital gains tax annual exemption for the 21/22 tax year is £12,300. Any unused exemption is lost. Try to use the annual exemption as far as possible. Consider making a transfer of assets between spouses where appropriate. If the annual allowance has already been used, consider deferring further disposals into the new tax year. Investments. There are various government-backed investment platforms such as Enterprise Investment Scheme, Seed Enterprise Investment Scheme, and venture capital trusts that give the incentive of income tax relief in exchange for the underlying investment carrying a varying degree of commercial risk. If you have surplus cash, consider making a tax-efficient investment. Certain conditions must be met in order to obtain the available tax reliefs, which would need to be carefully considered. Again, investment advice is strongly recommended here. Investment properties. Mortgage interest relief is now restricted to the basic rate of tax, resulting in a significant increase in the effective tax rates for some landlords, particularly where there are higher earners. Where you have borrowings attached to rental properties, review your operating structure to see if the arrangements can be made more tax efficient. Options include spousal transfers, use of partnerships, or incorporation. Thank you for your time today. If you do have any questions, please get in touch with us and we'll be happy to help you.